Did you know that most people spend their whole life working for money, but never make money work for them? Imagine waking up one day, and the first thing you do is check your phone. Instead of turning off the alarm and getting ready for a job you hate, you see notifications about your investments, which have generated passive income. And this passive income is greater than the salary you had at your last job. Seeing how your money grows without being tied to the job you always hated. That's not a far-off dream or something exclusive to millionaires. It's possible for you, whether you're a man or a woman. No matter if you're in your 20s or already in your 30s with responsibilities or kids, it all starts with a solid financial plan and building your own investment portfolio. If you've ever wanted to invest but don't know where to start, or if you think investing is only for successful people, those with luck, or it's too far out of your reach, this video is for you. Stay until the end because I'm going to show you step by step how to build a solid portfolio, even if you're starting from scratch. Let's get into it. What is an investment portfolio? First, what is an investment portfolio? Imagine your money is a football team. If you only have a star forward and they get injured, the whole team suffers. But if you have players in different positions, the team can still perform well. An investment portfolio works the same way. Instead of putting all your money in one place, like a single stock or cryptocurrency, you spread it across different types of investments, such as stocks, bonds, real estate, or index funds. That way, if one investment doesn't perform well, others can balance it out. Why is it important? Creating an investment portfolio is crucial because it allows you to play smart with your money, minimizing risks and maximizing returns. Here are 3 powerful reasons to do it. If you invest all your money in one stock, cryptocurrency, or sector, a bad day in the market could cause you to lose a lot. A well-diversified portfolio protects you because if one investment drops, others can stay steady or even increase. Different types of investments grow at different times. While stocks may rise, bonds can be more stable. By investing in several areas, you can benefit from market cycles without relying solely on one source of return. A well-managed portfolio not only protects your money, but also helps it grow over time. By investing in assets like stocks or real estate, you can generate returns that outpace inflation and increase your wealth. Today, you will not only learn how to invest, you're going to take the first step to make your money work for you. It doesn't matter if you're a beginner. With these steps, you'll be able to start building your financial future. Are you ready to take control? Let's do it. Step 1. Define your goals before investing a single dollar. There is something fundamental you must do. Define your financial goals. Investing without a clear goal is like getting on a boat without knowing where to sail. You could end up anywhere, or worse, sinking along the way. So, ask yourself, why do I want to invest? Is it to buy a house, for my retirement, to generate passive income, or simply to grow my money? What is my time horizon? Do I need results in a few years, or can I afford to play the long game? How much risk am I willing to take? Am I someone who prefers to sleep peacefully with safe investments? Or am I willing to take more risks for higher returns? Imagine this. 2 people start investing on the same day. One wants to buy a house in 5 years. The other is thinking about retirement in 30 years. Do you think they should invest in the same assets? Of course not. The first person will make safer and more liquid investments, while the second can afford to take more risks and think long-term. If you don't define your goal from the beginning, you may end up making decisions that won't take you where you really want to be. So, don't leave it to chance, because the difference between financial success and failure starts right here. Step 2. Know your investor profile. The next step is one of the most important. Getting to know yourself as an investor. Why? Because your portfolio should align with your way of thinking, your risk tolerance, and your goals. There is no one-size-fits-all strategy, and what works for someone else may not be ideal for you. There are three main investor profiles. Listen carefully and ask yourself which one you relate to most. Conservative investor. You are the type of person who prefers to sleep peacefully, without worrying about market volatility. Your priority is not to make quick money, but to preserve the capital you've worked so hard to earn. You prefer safe investments such as government bonds, certificates of deposit, or low-risk index funds. Example: if you invested money in the stock market and saw it drop by 10% in 1 month, would you get nervous and think about selling everything? If your answer is yes, this is your profile. Moderate investor. You are willing to take on some risk, but without going overboard. You seek a balance between safety and growth. Likely, part of your portfolio is in safe investments, but another part is allocated to stocks of solid companies or diversified funds to take advantage of market growth. Example: if the market drops by 10%, you don't panic, but you also don't ignore it. You understand that risk is part of the game and are willing to wait because your goal is mid or long term. Aggressive investor. Here we're talking about someone who seeks high returns and is not afraid of volatility. You don't get scared when your portfolio drops by 20% in a month because you trust that long-term gains will be much greater. You invest in high-growth companies' stocks, startups, cryptocurrencies, or even emerging markets. Example: if you see your investments drop by 15%, instead of selling, you see an opportunity to buy more cheaply. You have a long-term vision and understand that risk and reward go hand in hand. Why is this important? Because depending on your profile, your portfolio should have a different allocation. For example, a conservative investor might have 80% in bonds and 20% in stocks. A moderate investor might opt for 50% in bonds and 50% in stocks. An aggressive investor might have 80% in stocks and 20% in more volatile assets like cryptocurrencies or startups. There is no right or wrong answer. The important thing is that you feel comfortable with your strategy. Remember, investing is not just about numbers, but about how each decision makes you feel. If an investment doesn't allow you to sleep peacefully, it's probably not the right one for you. Step 3. Diversify your portfolio. If there's one golden rule in investing, it's this: never put all your eggs in one basket. Diversification is key to protecting your money and maximizing your growth opportunities. But what does it really mean to diversify? Basically, it means spreading your money across different types of assets to reduce risks. If one sector of the market performs poorly, others can make up for it and keep your portfolio stable. Here are the main types of investments and how they can help you build a balanced portfolio. Stocks. Long-term growth investing in stocks means buying a share of a company. If the company grows and generates more income, the value of your stock will also rise. Who is it ideal for? For those seeking high returns and who can tolerate volatility. Example: investing in tech companies like Apple or Microsoft. Bonds. Security and stability bonds are essentially loans you make to governments or companies in exchange for interest. They are less risky than stocks and help maintain balance in your portfolio. Who is it ideal for? For those seeking stability and reducing the impact of market downturns. Example: U.S. Treasury bonds or corporate bonds from solid companies. Index, funds or ETFs, automatic diversification. If you don't want to choose individual stocks or bonds, index funds and ETFs are an excellent option. Essentially, you buy a basket of assets that tracks an index like the S&P 500, giving you access to multiple companies in a single investment. Who is it ideal for? For beginners seeking a diversified option without complications. Example: an ETF that replicates the S&P 500 with companies like Apple, Amazon, and Tesla. Real estate and precious metals. Investing in real estate is one of the oldest and most effective strategies for building wealth. It involves acquiring properties with the aim of generating passive income, rent, or selling them in the future for a higher price. In my opinion, this is one of the best assets to invest in since no one is building land, but buildings for housing and offices. Who is it ideal for? For people looking for stable, long-term income and those with initial capital or access to financing. Example: buying properties in growing areas, renting them out, and selling them in the future when their value has increased. Cryptocurrencies. Cryptocurrencies have revolutionized the world of investments. They are decentralized digital assets that run on blockchain technology without the need for banks or intermediaries. In upcoming videos, I'll go into more depth on this topic. Who is it ideal for? For those looking to diversify with digital assets and use new technologies. Also for people who can understand and accept market volatility. Example: buying cryptocurrencies like Bitcoin, Ethereum, Solana, precious metals, gold, silver. Precious metals, especially gold and silver, have been valued for thousands of years as a way to safeguard wealth. In times of economic uncertainty, investors often turn to them because they hold their value better than other investments. Who is it ideal for? For those seeking stability or who are worried about inflation, or for those looking to hold physical assets. Example: buying gold or silver. Final tips for proper diversification. You don't need to invest in everything right from the start. Begin with what you understand and expand over time. Don't put more money into high-risk assets than you can afford to lose. Review your portfolio periodically to adjust it according to your financial situation and goals. Remember, the key is not just how much you invest, but how you distribute it. Good diversification can make the difference between a portfolio that grows over time and one that suffers major losses during a crisis. Step 4. Review and adjust. Finally, a portfolio is not something you set up once and forget about. You need to review it regularly, at least every 6 months, and see how your stocks have moved. Also, ask yourself the following questions. Are you still meeting your goals? Have you kept saving and researching the fields and companies you want to invest in? Have you calculated the potential risks, made several investments, and achieved your goals based on that? Has your risk tolerance changed? Are you more patient and less reactive to the ups and downs of stocks or how the market moves? Do you think more with your head and not let emotions guide you? Is any asset no longer working as expected? Reevaluate and think if you can still ride the wave with this asset, if it could eventually go up and generate profitability, or if it's better to let it go and focus on another type of asset, like a different stock or investment. It's important to be aware of how investments in your portfolio affect your tax situation. Some capital gains may be taxed at higher rates than others, depending on how you manage them. If you have a large portfolio or make many transactions, you might consider speaking with a tax advisor. Market conditions change constantly, and so does the nature of investments. Keep track of economic, political, and sector-related news where you invest, so you can adjust your portfolio to any relevant changes. Make adjustments as necessary, but avoid making impulsive decisions based on emotions. Remember, investing is a marathon, not a sprint. And there you have it, the basic steps to build your own investment portfolio. Now it's your moment. Take the first step toward the future you've always dreamed of. It's not just about investing money. It's about investing in your dreams, your goals, and your financial freedom. Remember, every small decision counts, and each step gets you closer to your financial independence. Don't be afraid to start. The journey may be long, but every investment you make today will be the birth of your success tomorrow. So, invest with purpose, research, learn, and most importantly, be patient. Time is your greatest ally. If this video helped you, don't forget to like, subscribe to Bank It Up, and hit the bell for more content on how to grow your money. The future belongs to those who take action today. Are you ready? See you in the next video.